My name is Kling, and I did my interest rate forecasting project for one-year Treasury yields on the week of October 21st through October 25th of 2013. That week, the interest rates fell slightly, as you can see in my chart back here, but over the 10-year projection, it reflects a positive increase in requirements. The red line is for the 21st and the black line is for the 25th. The positive slope reflects investors expect the economy to grow in the future, and for this growth to be associated with a greater expectation that inflation will rise moderately in the future. The expectation of higher inflation leads to the expectation that the monetary policy would be tightened by raising short-term interest rates in the future to stimulate positive economic growth and dampening inflationary pressure. Two unusual factors during this period may have impacted the projection, specifically the government shutdown and the third-party credit rating factors. Initially, the government shutdown increased uncertainty in market investors' minds, which led to an increase in interest rates and yields. As the shutdown came to an end, however, current rates dropped because of two main reasons. Security risk to the holder declined, and the expectation that the economy would be able to grow again with a stable government financing package in place. The uncertainty of the government staying open, with another shutdown possible in a few months, could be reasoning for a decline in forecasted rates for longer maturities, which it shows my chart right here. And the longer maturities, it drops off and goes away from the increase, the steepening of the curve. Another factor that was the threat by Moody's Investor Rating Services to lower the credit rating associated with the United States government debt due to uncertainty as to the ability of the government to meet those debt payments. A lowered rating indicates a lack of security, uncertainty, which would create an increase in rates for increased risk created by security uncertainty. Simply stated, an issuer's rating will greatly impact what interest rate they can expect to pay when issuing debt. Uncertainty or lack thereof is an important factor in credit rating analysis processes. The future expectations of, despite the government shutdown and third-party credit factors, is irrespective to uncertainty factors, interest rates are expected to rise in the future. Good news is that even though the expected interest rates are expected to increase, they are still at historical lows, thus providing a positive base for economic growth. Some would ask why or what provides investors a base for that supposition. Simply put, an economic policy response to quantitative easing, which is controlling interest rates growth by manipulation of economic monetary supply policy. A basis for that conclusion probably has to do with the expectation of Janet Yellen, which was the expectation of Janet Yellen, becoming the new chair of the Federal Reserve, replacing Ben Bernanke. Yellen is a proponent of low to negative interest rates and feeding more money into the economy in order to stimulate growth without increasing inflation. Yellen is also perceived to be more willing to extend quantitative easing and not taper with it, which is to allow it to adjust in response to natural market factors. The result of this policy would further stimulate the economy by purchasing assets of longer maturity and thereby lowering long-term interest rates further out into the yield curve. The simple fact of quantitative easing is essentially raising the prices of financial assets bought, which lowers their yield. An example of continuation of the policy is the recent Fed decision to postpone the stimulus pullback because rates rose significantly from the beginning of May. The announcement of the postponement of the tapering of the stimulus resulted in a continuation of decreased interest rates by a fair amount, thereby allowing the economy to grow and rebound. The risk of continuing the quantitative easing is if regulation does not work, the FOMC is at major crosshairs and must decide between using monetary policy to slow a bubble and potentially harming growth, or doing nothing and risking future damage to financial stability. In conclusion, after observing the interest rates through the week of October 21st through October 25th, shows that the current yield decreased slightly, but the expected one-year Treasury yield is shifting upwards over the 10-year maturity, as you can see in this chart. This shows an expectation of growth in the economy. However, as seen in the projected forecast of the 10-year maturity, the yield curves downward at higher maturities, mainly between 9 and 10 years. This could be a result of a possible second government shutdown in a few months, or the news of Janet Yellen to be possible new chair of the Federal Reserve, along with many other possibilities.